Hi, everybody. All right. So I see a couple of familiar faces here. I see Mike. How you doing, Mike?
I'm good, Jason. Long time no chat.
Yeah. I don't. I'm excited. Hopefully, you guys can learn a little bit today. We're going to be talking about tax planning, and is tax planning really worth it for real estate investors? So I'm going to pull up my screen, and then I'm going to share my screen, and then we'll take it from there. Okay, you guys, and then if you guys have any questions, we can have a little Q&A at the end. How does that sound, you guys? Good? Okay. Please don't be shy, you guys. I want this to be as a as as a community as possible. All right, you guys. So I hope you're excited because I am too. All right, so let's start from the beginning. All right, here we go. All right. Can you guys see my screen? Yes, right. I'm seeing Mike nod, so I'm assuming
Yep,
that.
nope, it's here.
Excellent. So as mentioned before, we're going to be talking about tax planning. And right now, October, November, December, this is the time that most people will start asking about tax planning. Okay, so this is very important because I get questions all the time from real estate investors and business owners. Is tax planning worth it, or is it just a scam for financial professionals and tax professionals to charge me a lot of money? And I'm going to answer that question for you tonight. Okay, so let's go on to the next slide. Okay, so who am I? My name is Jason Malabute. I've been a CPA since 2015. I've been doing tax and accounting since 2013. I'm also a certified tax coach, meaning that I've done several tax plans this year, and I'm actually doing a tax plan right now, and I'm saving my current client right now hundreds of thousands of dollars because they sold a property recently. And on top of me being a tax professional, I'm also a real estate investor myself. So I've been in the trenches. I've invested in single family. I've invested out of state. I've done multi-family deals. I'm a general partner on multiple multi-family deals.
Hey,
So
Jason, your syndication deals. Do you have TIC investors or DST investors in them?
no, no, because those ones get more complex. So all of our other investors are not none of those things.
Okay.
Yeah. So okay, so moving along. Okay, so what is the problem when it comes to traditional tax preparers? Is that I would say 99% of tax preparers are all reactive, meaning you just see your tax guy once a year. Like it's either March or April, or if you are a procrastinator, not until September or October. And then they don't really give you any tax plans. All they do is help you file your taxes, which is more on the compliance side. Then by the time that they see your numbers, it's way too late. I always tell my clients that after December 31st, I mean, it's very limited on what I can do for you from a tax planning perspective. And some of the most common opportunities that are missed by tax preparers because they're being reactive is it's helping you select the correct entity type, right? Depreciation acceleration, which is a very hot topic right now, especially in the real estate world, because of the one beautiful bill that just passed last July. Also, capital gains deferrals. Everybody here knows about 1031s, and also income and expense shifting. Also, those are some very big opportunities that a lot of tax preparers don't take advantage of because they're all being reactive. And what do I mean by income and expense shifting? Well, one of the most common examples of income shifting is if let's say you are a high income earner, and then let's say that you have the highest tax bracket. Well, if you go to a experienced tax strategist like our team, one of the things that we would be looking at is, okay, would it make sense for you to consider looking at a C corp, right? Because when you do a C corp, you're getting taxed at a flat, lower rate. So like that's something that we would look at. And one of the most common misconceptions when it comes to tax planning is that there is no blanket cookie cutter strategies that you could give to all your clients. Everybody's tax situation is different. So therefore you have to see what's their tax situation, what's their business situation, and also what's their goals before you start considering which tax strategy should we be looking at, right? So those are some of the things that's often missed out. And then by you as a taxpayer being reactive and without you doing proper planning, you are giving up control, right? You're giving up control on how much can you minimize your tax liabilities. And remember what I told you guys. True tax planning happens before December 31st, not after. Right? Because Mike will tell you after December 31st, it's very limited on what can we do, which is what mostly maximize your guys' retirement account. So that's something to be aware of. Let's move on to the next page here. Okay. So, it's very important to plan your outcome before year end, right? Meet with your tax professional. Tell them, hey, Mr. CPA, my boss just told me that I'm gonna get a raise this year. Oh, our business is expected to go and double our gross revenue compared to what we did last year. Oh, I'm thinking about getting married. I'm thinking about getting divorced. We're expecting to have children. We're thinking about starting a new business. We're thinking about buying new property. We're thinking about buying new equipment for our new business, right? All those things you should be talking to your CPA about because then we can strategize what's the best tax strategy for you to consider before you pull the trigger on that move, right? Um, so I've already mentioned some of these strategies before, but we'll go over them again, right? So there's income shifting. Like move income to somebody who has a lower tax bracket, right? Same thing with the expense shifting. Time large expenses for a year that you're expecting higher income, right? So like if let's say in 2025, you're expecting to have a higher income. You're thinking about buying this equipment anyway in January of 2026. So why not consider buying it in 2025 instead so you could use that expense towards a higher income rate year, right? And then also timing and deferrals. We talked about okay, um maybe you can go and see if you could delay that bonus, if you could delay that particular income from hitting your books this year. And some of the examples that we have here in the bottom when it comes to income shifting is do you have children, right? Mike has children, and he'll tell you that when they're growing up, you need to pay them allowance anyway, so we're not get a tax advantage from that. Paying them allowances, right? And then teaching them also what is the value of hard work. So you're killing two birds with one stone. And then when it comes to expense shifting, you could go in there prepay, insurance if you're doing cash basis. You can look into doing more charitable donations. And then when it comes to entity choice, right? Are you paying a lot in self-employment tax? Well, if you're paying a lot in self-employment tax, does it make sense for you to be an S corp? My answer is maybe yes, maybe no. Because sometimes yes. By you shifting to an S corp, yes, you can cut down your self-employment tax, but maybe you're gonna be losing out on the KPI deduction. It really just depends on your situation, and then you need to talk to your tax professional, have them run the numbers, and then have them see what is the best route for you. And when it comes to timing and deferrals, okay, did you just sell a property? Okay, have you considered doing it since you want to exchange this year? Have you considered doing a bonus depreciation this year? Would a bonus depreciation even benefit you, right? Because if a bonus depreciation doesn't benefit you, for example, if let's say you make more than $150,000 per year, or if you don't qualify as a real estate professional, then maybe a bonus depreciation is not going to be worth it for you. So that's why tax planning is so important because you could know, is it worth the investment? Is it worth the cost before you proceeding with that initial investment? Whether that's a 1031 or that's a bonus depreciation, cost segregation, all those things cost money. All right, moving along here. So what is the ROI of a tax plan? So I want you guys to look at a tax plan as an investment, not as an expense, because I'm always in bigger pockets, and one of the most common things that I see on Bigger Pockets is people are complaining about CPA costs, and something that I always tell people is if you want good advice, that does not come cheap, right? So, for example, imagine if you have cancer, or let's say you have a heart problem, you're not going to try and go to the most cheapest doctor, right? So same thing when it comes to your tax and accounting needs. This is not the time to go and try and save pennies, right? Like you should be looking at value, not cost. And you need to compare, okay, how much tax savings am I going to get? What's the likeliness of this strategies standing in the court of law, just in case I'm ever questioned by the IRS? Does this tax professional have experience? How much experience does he have? Has he done the tax plan before? Those are the things that you guys should be looking at as entrepreneurs, as real estate investors, as high income earners. Don't worry about the price. Worry about the value of the tax plan, and most importantly, how soundproof is that tax plan, right? Did the tax professional do the research on the tax code before they started advising you on tax plans, right? So so here's the thing with tax plans though is that there's two kinds of strategies. There's the kind of strategies that require cash outlays. So that means buying rental properties, whether it's short term or long term. That means doing a 1031 exchange, doing charitable contributions, doing retirement contributions. Then there's also things that don't need cash outlets. So those are things like doing a step up in basis if let's say one of the spouses dies, right? S corp election, C corp election, grouping elections for real estate professionals, timing, income and expenses, shifting income and expenses. Those things don't require cash outlay. So in my opinion, they are more valuable because they're more accessible to more um investors, business owners, and individuals because money is not something that's needed to go and implement that tax strategy. So that is why, as a tax planner, as a tax strategist, I try to look for no cash outlay tax strategies first before I start looking for ones that do require cash outlay. Be, because if you present a client with only strategies that require cash outlay, and if they don't want to do those strategies, if they don't want to spend money, then you are severely limited, right? So moving along here. All right, so I'm gonna have some examples here of some high value tax planning opportunities. One of the more popular ones is short-term rental loophole strategies. This is for people who want to offset their active income without losses from their rental activities and might have a hard time qualifying as a traditional real estate professional. It is because
Jason, question
yeah,
for you, real quick. What about if you have an Airbnb and you rent it 80 days, short-term rentals for the whole year, but you also use it 120 days because it's in such a nice location? Does that screw up your strategy?
that that one I would have to double check on that one, Mike. I'm gonna be honest with you. I'm gonna have to double check on that. But
Okay,
but
I would
but
really appreciate that because I know a couple of people who do that. So,
yeah,
okay.
but
Okay, great. Thank you.
yes, but as far as I know, you guys, as long as the average stay is less than 7 days, and that you are actively managing the property for 100 plus hours in a year, and you are logging your hours, then you should be good, Mike. You should be good when it comes to the short-term rental loophole. But I will definitely check on that. Okay, so as mentioned before, some of the things that's very important is that you hit that 100 hours. You're logging your hours. Documentation is very important. And make sure that nobody else spends more time managing the property than you. So then therefore, I'm not saying that you can't have a property manager, but what I'm saying is that if you did have a property manager, that makes things harder, right? That makes things harder to qualify for the short-term rental loophole. All right, so a common question that I get asked is what counts as a 100 hours rules when it comes to the short-term rental loophole? And something that I tell my clients is that one easy way remember it is that as long as you are actively managing the property, so that means you're the ones changing the sheets, you're the one that's fixing stuff in the property, so you're the one handing the keys to the tenant. That counts as as for the 100 hours. But if you're doing investor activities, that means that you're looking at that profit and loss. You're looking at what's your cash flow. You're looking at potential opportunities to go and buy more deals. That does not count for the 100-hour rules. All right. So so once again, you could use this to offset your W-2 income. You can go and deduct mortgage interest. Very important. You cannot deduct mortgage principal. All right, you guys, you can only deduct mortgage interest. Then you can deduct taxes, insurance, furnitures, repairs, utilities, blah blah blah. Okay. Um, and then you can combine the short-term rental loophole with bonus depreciation, which starting this year you can get 100% so that you can really maximize your tax deduction. Okay, and then that is how you build equity and cash flow while you are still lowering your taxes. All right, so let's continue. Let's see what's the next high value tax planning opportunities. All right, so here's a more traditional tax plan when it comes to real estate. So this is a long term buy and hold tax plan. So a couple of things here. So if you make less than $150,000, you could deduct up to $25,000 of our passive losses towards your active income. But once you start making more than $100,000, that starts to get phased out. Then once you hit $150,000, then that's completely phased out. The next strategy is becoming a real estate professional, right? So a couple of things here. You have to spend more than 750 hours dedicated to real estate, 500 hours material participation, and you need to dedicate at least 51% of your time towards real estate, right? I know that if you guys go on social media nowadays, it seems like everybody is saying that there's a lot of cons when it comes to marriage. There's no benefits to marriage, blah blah blah. But what I will tell you is that one benefit to being married is that only one of the spouses needs to qualify as a real estate professional for both spouses to enjoy the benefits of being a real estate professional. What do I mean by that? So imagine this, right? Imagine you are Mike Gavigan. You are a super successful accounting firm owner. You're making $1 billion per year from your real estate firm, and then you pay yourself a nice handsome W-2 income, and then let's say you have a stay-at-home wife, right? If your wife qualifies to become a real estate professional, and then let's say you guys have a bunch of rentals here in California, well then you could use those passive losses from your rentals to offset Mike's super high W-2 income, right? So that's one advantage of you guys being married. Okay? So so once again, uh, um, you could use it as a one-two punch, right? You could go qualify as a real estate professional, and then at the same time, go take advantage of the cost segregation, bonus depreciation. Once you go and do that, then you can maximize your tax deductions even more. Uh, so here is another high value tax planning opportunity. So let's say you sell a property. Well, there is a couple of things that you could do here. You could do a 1031 exchange, right? You could do a partial 1031 exchange, as you guys know, there's two cool things that happen when you do a 1031 exchange. Not only can you defer the capital gains, but you could also defer the depreciation recapture. Does anybody here besides Mike know what is depreciation recapture? Norman, Richard, do you guys know what's depreciation recapture? I'll give you guys 5 seconds. If nobody answers, I'll answer it myself.
There was an answer there, the 25%.
Yes, there you go. That's 100% correct. Depreciation recapture is taxed at 25%. And just for you guys that don't know what depreciation recapture is, that you are taxed at 25% for whatever depreciation that you have enjoyed in previous years when you sell the property. Okay. But I would say that 1031 is the most taught about that strategy, and sometimes I feel like it's so played out when it comes to real estate talk. But there's also other options as well, which is property donations, right? So like if let's say you bought a property for let's say 400,000 in 2000, then now it's worth 900,000, right? Now it's worth 900,000 in 2025. Well, normally you'd be forced to pay capital gains tax on that 500,000 of capital gains. But if you donate it to charity, that's one way for you to avoid paying the capital gains. Plus the cool thing is that you can go and deduct the fair market value of the property that you donated. And for this example, it would be $900,000, not $400,000, right? And then going back to the whole thing, that you want exchange, you can go keep on doing that. You can keep on deferring the capital gains until you die, which is called the swap till you drop strategy. Okay, so let's keep on going. We're almost done. I hope I'm not boring you guys too much. All right, so here is a funny story that I get that I wanted to ask you guys. One common question that I get asked all the time when it comes to house flippers is that they always ask me, how much capital gains do I pay on my house flips? And the answer is, you don't pay capital gains on your flips. Why? Because flipping is considered a ordinary active income. It's not a capital gain. Okay, so like unfortunately, one of the most common myth, myth out there, especially in the real estate community, is that people always say, okay, whenever you're in real estate, go get yourself an LLC for tax purposes. And I want to debunk this right now. LLCs do absolutely nothing for you when it comes to tax purposes. LLCs is more for asset protection and liability protection. Okay, so whenever you have active income, like let's say flipping, you are setting yourself up to be potentially getting hit with a high self-employment tax, especially if you're using LLC. So that's something to be careful about. So one of the things that you can look into is it worth me looking into becoming an S corp? However, if you become an S corp, you need to pay yourself a reasonable compensation, and you need to pay yourself a reasonable compensation before you do a distribution. And you cannot just make up your own reasonable compensation, you guys. You need to go to somewhere like let's say RC reports. That's what I use with my clients. I send them a questionnaire from RC reports. They answer questions about what is their duties when it comes to their business, how much time do they spend in the business, and then that's how we determine what is a reasonable compensation. So here's how it works, right? If you have an LLC, and then let's say you have a profit from the LLC, well, what happens is that you can get taxed with self-employment tax for that entire amount when it comes to LLCs. But when it comes to S corps, you only pay payroll taxes on the W-2, and then whatever you take after the W-2, it's called a distribution, and that's not subject to payroll tax. All right, so that's something to consider. And then as mentioned before, C corps are great. If you are a high income individual, because then you get a flat rate of 20%. Okay, so something that I forgot to mention when it comes to S corp, you guys, is that you really need to know what you're doing before selecting to become an S corp. Because if you, by mistake, select to become an S corp when that's not the best legal entity for you, that's just too bad, because now you are stuck for 5 years. Okay, so that's that. Let's go on to the next one. All right. Does anybody have any questions for me? Let's check the chat. Let's check the chat just in case. Okay, I don't see any questions. Going once, going twice.
I'd love to see your question, Jason, that you give to your clients to get them started on a tax planning, because I think you've got some really good info here, and
Yeah,
I'd like to see what else questions you're asking.
yeah.
And later, I would like to get a little bit more understanding of qualifying for an active investor. I know you have lots of experience in real estate, but you don't qualify not for the short term rentals, but for the
Real estate professional.
regular rental properties.
Yeah, real estate.
Okay.
Yeah, and that's no problem, Mike. just to give a little bit of insight on that, when it comes to the questions that I ask my clients when it comes to tax planning, some of those questions include stuff like, what are some personal expenses that you are looking to incur in the next 6 months or so? That's important because then we know how much can they pay in taxes and how much do they have to save. Um, Also we want to know questions like what's the most important thing to them? Is it cutting down the tax bill? Is it finding the next investment? Is it them becoming more organized?
Hmm.
By
Hmm.
by them answering those questions, then we can create a perfect tax plan for them. So those are some of the questions I like to ask my clients. All right, you guys. If you guys have any questions, please reach out to me. If you guys need help with your tax plans, reach out to me. If you guys need help catching up with you guys' books and accounting, reach out to me because right now we are having a crazy sale right now. All right, you guys. So thank you very much, and I hope you guys have a happy Halloween. Talk to you guys
Very
soon.
good. Thanks, Jason. I really appreciate it.
Bye.
Really good job. Thank
Thank
you.
you.
Mhm.